Awesome. Thanks, Rich. Thanks, Dan. Appreciate the opportunity. Welcome everybody to the call. Again, yeah, we'll do the same old thing that we normally do. I'll spend some time talking about marketing plans. And basically, my target today is to do two things. One, I want to provide outlines and progress updates for 2025 corn and wheat marketing plans. And I just want to note, as we always do, that these plans and decision outlines they're not considered advice, but the idea is we want to give you an example, right? If you haven't priced any new crop corn, we're going to throw out some ideas and some targets, and maybe you should think about it, right? And you can use ours as a benchmark. Please work to do better. But I feel like it's so important that we kind of get going and that people start developing plans and then actually following them, and then asking yourself, why aren't I doing something? You know, Mark's using this for a price target. Why shouldn't I? What would be a better one? Now, I might real quick here just uh, turn off the video space, save a little bit of bandwidth there. But so again, the second thing I want to do then is provide some background regarding our winning the game cost estimates. A lot of times I'll refer to those. Here's our target, but it's easy to do that. But it's more important to get a handle on what your costs are, obviously. And then something that we haven't done before is I want to try to take my futures-based price targets and maybe relate that back to forward cash contract bids. Because typically, when Dan and I have gone out and done meetings, we kind of ask people, are you using futures? Typically, we don't get too many people saying yes. We ask, do you use forward cash contracts? We hear people say a lot. So what I'm going to try to do is relate these futures-based price targets that I use because I think it's easier to talk to a broad audience with futures-based targets. But then how does that relate back to kind of what you're seeing out in the country? So let's get moving here. Um, all right. So second things, and these other items they are in the handout, but I will not talk about them, right? I've got a 2025 soybean outline and progress update, so price targets, etc. I've got corn, soybean, and wheat futures price index analysis. Basically, I always talk about that 15-year index. Got about 3 slides for both corn, soybeans, and wheat that kind of look at that issue. I've shared them before in the past, but I just got those updated and they're in there. We've also got corn, soybean, and wheat post-harvest storage comparisons. Now, again, those are using our state of Kansas average price, and that's a lagged data series. So it's really only going through about December. We'll get the January numbers here at the end of this month. So it's always kind of a lag thing. But bottom line, to date, post-harvest storage hasn't looked too good. And then I also have in there 3 slides that hit back on a flashback, I call it, of 2024 post-harvest wheat called spread. Back in June of last year, we were starting to analyze, would storage work or would storage not work? It didn't look very profitable as we were going into harvest. And so we started throwing out some other options, some other ideas that people could do. One of them could be to buy a call option to ride any kind of futures price rally, or another one would be to put on what we call a wheat call spread. I kind of use 3 slides to kind of show you how that turned out. So those are things that are slides in the handout. We won't go through them today. So what goes into a marketing plan? Well, everything, right? Everything goes into it. Your production costs, quality, timing, price outlook, basis, local markets, tools, storage, transportation, all these things go into your plans, which make every marketing plan a bit, I'd say, very, very unique. Now, currently, there's a degree of chaos occurring, right? A lot of uncertainty, and I look forward to hearing what Dan's got to say today because I think it's never been harder to do market outlook. But also, from a farmer standpoint, it's never been harder to make marketing decisions, right? Just a quick recap. There's the 25% tariffs on imports from Canada and Mexico. They were delayed until March 4th. So we'll find out more next week, right? 25% tariffs on all steel and aluminum imports are slated to start on March 12th. Now, is that posturing? Is that bargaining? Are they going to go in place? Are they not? Congress needs to pass a budget or a continuing resolution to fund the government by March 14th. How might that impact markets? And also, there's a review of possible reciprocal tariffs the president has asked for on all major trading partners. That's due in early April. So there's a lot of things going on right now that is going to cause a lot of volatility and a lot of uncertainty. But I would throw out there that while a cautious approach is recommended, it's never been more important, right? To have a marketing plan. Never been more important. What goes into that? Well, the three key things are pricing increments, right? How much do I want to price each time? Pricing targets, right? How much and what price am I looking for? How high do futures have to be? What kind of a forward cash contract bid will I take that would make me take action and sell? And then date targets. And those are designed to compel action, because if my price targets don't hit, when that date target hits, maybe I should still take action. All of those three things, coupled with your pricing tools, forward cash contracts, options, futures, those those that you select can guide your decisions, lead to action, and hopefully help take some of the emotion out of marketing. All right, so here's a quick start for what I'm looking at as far as maybe a good idea for where we want to go with a sample pre-harvest 2025 feed grain plan. Now, in my mind, as I look at corn, beans, and wheat, corn appears to be the market leader. We've seen some fairly strong exports lately, but I'm getting a bit cautious. It'd be fun to hear what Dan has to say, but a lot of folks are suggesting we could see a fairly significant increase in corn acreage. How will that impact our prices? Some folks are throwing out 94 million acres. And if that crop goes in good shape, that could be very negative as we go through spring. If things are dry, it'd be different. Seasonally, again, kind of going back to those 15-year seasonals, we'll see our best pricing opportunities from early April through the first half of May. And then again, in that first half of June. Those are typically when seasonally we'll see some price rises in that December corn contract. Also seasonally, there's about an 80% chance that we'll see a 20-cent rally over the January 1 price. A 50% chance for a 65-cent rally over that price, but only a 25% rally for any kind of rally, $2 or more. So 1 in 4 years, we'll see a really good rally. The rest of the time, and last year included, prices never got above that January price, and we need to keep that in mind. Another thing we do when we talk about our, winning the game, if you're using a cash marketing alternative, we really suggest you avoid pricing at less than your expected production cost per bushel. Now, in our winning the game KSU numbers, our total cost estimate for the state of Kansas would be $4.32 a bushel. Again, price come down a little bit this year. Direct cost, or what I would consider variable costs, adding back in also cash rent, because a lot of farmers out there are cash renting ground, and so that's really a variable cost you've got to pay up this year. So from a cash flow standpoint, you got to come up with the funds. That break even is about $3.59. So our plan looks like this. The January 1 December price was $4.46. So I'm kind of relating our rallies to that price. We always suggest buying crop insurance to protect production risk. And then the goal should be to maximize price on any bushels sold. So our first increment, and we had that lined out back in January when we last met. We had a 466 December target. We've actually hit that. Our second price target is another 10% at 483 December futures, but our date target is June 15th. So we're giving ourselves some time to hit that one. And then at that point, it's a 3A or a 3B, whether we, let's get another 10% done quickly at 493, or do we want to be a little bit more aggressive and just wait for a 510? I think there's some reasons to look at either one of those. 3A would be a 47-cent rally from that January 1 price. A 510 price target gives us a 64-cent rally. So again, that's kind of hitting into that 50% chance range. Now, a little bit more about 2025 farm budgets. Every year, K-State puts together budgets for the coming crop year. And for this map I've got the direct cost. Again, so that would be variable cost, but I'm adding back in cash rent. What goes into that? Well, direct expenses include crop consulting, additional labor, crop insurance, customs, or custom operations, diesel, fertilizer, fungicides, all these variable costs of production, interest on capital, labor. A fixed cost would include a cash rent figure, and as a land cost, and then capital recovery, so depreciation and interest. Now, what I do is I start with that direct cost, but I'll add back in cash rent. And so that's what these numbers on this chart, this map, indicate. So for example, Northwest Irrigated, K-State's budget is 240 bushels per acre, but the direct cost plus cash rent gives you a break even of 322. North Central, a little bit higher yield or the same yield, 240. Its cost is 321. Southwest Irrigated, 225 bushels, 321. South Central, 225 bushels and 327. You can find all those at agmanager.info/farm budgets. Now, as we go across the state, Northwest wheat, corn, fallow budget, it is 89 bushels per acre. But the direct cost with cash rent is 446, quite a bit higher. Why? Well, we've got that fallow ground. Same thing with Southwest. Now, as we go across the state, yields kind of on the dryland side, yields kind of bump up. We don't have to worry about fallow. And so my costs start coming down. And as we go clear across, now we're starting to see more expenses as we go. That cash rent's a little higher as we in the eastern part of the state. So we're looking at 397 and 343. That gives me a Kansas weighted average, right? Because what we tried to do was wait how many bushels each year come from each one of those budgets. How much corn is grown under each one of those conditions. And that's so we created a weighted average. It's 157 bushels, and that would give us a 359. So that's kind of how we come up with this state number that I'll often quote. Again, if you look at the variability across the state, even with this within these budgets, which are done incredibly consistently, right? I think it drives home the fact that it's very important to know your costs. While the irrigated cost per bushel really were pretty similar, but it's because we're building these budgets with a lot of the same assumptions. Every irrigator out there is going to have a different energy source, a different well depth, a different pumping cost, different costs associated with that. And so really, it's never been more important to know what your costs are. But I wanted to give you a little bit of background on where we're coming up with these costs. All right, so pre-harvest corn plan implementation. We're trying to start this thing January 1. December corn futures were 446.5 on that first trading day. I think we met did our last webinar January 27th. We had a target of 466. 2 days later, the market hit that. So we did it. We did 20%. So now we've got 20% priced at 466. Our minimum price is 432, etc. Looks like we put in what I would call a double bottom. And since then, we have now also met the 50% retracement. So where do we go from here? Well, our target's 483. Part of that is because of that 485 line. We went lower and then we bounced back up back in June of last year, right? Couldn't get through it, but that also represents a 67% retracement. So I feel like that is a good place to put in another target, my next target. Now I'm using 483 because, okay, the market may trade up to 485. It may not close there, but if we can hit that 485 and we can get a close at 483, I'd suggest we take it. Now, when I checked at 11:30, we were seeing corn down at 469. So we're approaching my line of support, but still that's holding. So again, the hope is let's take some patience. Let's see if we can get this market bounce back up to that 483 and let's do a percent. Again, from a farmer standpoint, you need to be asking yourself, if I haven't done any pricing, should I be? And where would be a good price target? After that, I'd be looking at maybe the next target would be that 5 or even 513. Again, we have we back in May of last year, right? We got as high as $5. That would suggest to me that maybe that 493 could be a good target. Or you could say, hey, for that next increment, I'm going to wait till we get up to those prices that we saw last November, right? Way back, and even back in 2023, right? In early 2024, where we saw 510. But this market's got to really move to get up into those areas. Okay, so that's where I'm at as far as my targets. How does that go back and relate to forward cash contract bids? Well, what I did was I just grabbed 6 locations across the state, plugged in my December corn futures 475, found out what all the forward cash contract bids were. So, for example, Colby Cornerstone Ag was 440. That's an actual new crop basis then of 35 cents under. Something I want to point out is that 448, my composite 6 location average, is actually beating our composite total cost of production. So there's a lot of uncertainty out there. Should we be, if we haven't done any pricing yet, should we be considering doing some of that? Because the market appears to be offering a lot of us an opportunity. The other thing, my 483 target, that would roll out to about a 448 if we use that same 35-cent basis in Colby. For Chanute, that target of 483 and a 24-cent under basis would say that would give me a 459 price. I do want to point out though that 448, so my 483 futures target, that would result in a 448, hopefully forward cash contract. If you look at North Central Kansas, that's not covering total costs, but it is covering direct costs with cash rent. So again, it's important that you kind of look at your own situation, but that's kind of where I'm coming out on these targets. If you go back and you say, well, what's the 5-year average new crop basis? I've got that listed for all these locations. And the point I want to make with that is that new crop basis bids are nearly 40 cents weaker than average. Now, every place is a little different. Some are giving us a little bit better bids. Chanute, they're offering 24 cents under. Normally it's 6 cents under. Not as bad. But again, Colby, 21 cents over versus 35. That's a way weaker than normal basis. And I think this kind of hits on the fact that some of the things that we had talked about last month, that a lot of buyers had already kind of bought up on the corn needs. And maybe we weren't seeing as much pressure for them to pull that stuff out of the country. Again, very important to know what your costs are. As we roll into a sample pre-harvest 2025 wheat plan, I'm going to say that it was originally built with a very bearish viewpoint. But now, exports have kind of turned around. Things have gotten more positive. We're starting to see a bit of a rally. Seasonally, we see our best pricing opportunities in late October to early November, so last fall. And then in early March and again in May, so right before harvest. Seasonally, there's also an 87% chance that we'll see at least a 35-cent rally over the January 1 or October 1 price. I'm sorry, that's a misprint. October 1 price. A 67% chance for a 45-cent rally over the October 1 price. A 40% chance for something as large as $1. So again, less than 50% chance. And then a 20% chance, 1 in 5 chance of getting $2 rally over that October 1 price. If we're using cash marketing alternatives, we would suggest avoid pricing it less than your expected production cost. Again, our winning the game KSU weighted average total costs are $6.91 per bushel. Direct with cash are $5.54. Plans should begin no later than October 1. Last fall, though, wheat futures were in a major free fall. And so we got a little bit panicked, priced about 30% of expected APH prior to the 1st of October at levels that were below the total cost but above direct. So let's get moving and take a look at this real quickly. So we priced there at the end of August, 8/30, 588. We did 10%. We had a target then at that August meeting, and we said, or webinar, we said if we can get a 50% or 33% retracement up to 624, let's do it again. We did reach that. So we priced that. We had a higher target then. We never did reach it. Now, the market did go a little higher before retreating. So we've kind of now moved across, and it looks like we've again set in a bit of a double bottom. So targets right now, we're looking at a 640 target, which would mean a return to those peaks that we saw here just recently, and that we also saw back in the end of or the first part of November, right? So we're looking for maybe a rally up into that 640 range. That would, because that might stop, and that would also be a 50% retracement. So again, that's kind of where we are. If we can get that, we do 10%, we'd be 40% price. At that point, let's sit back and kind of wait, see if we learn more about where the U.S. tariffs are. We'll end with this one here, same kind of analysis with pre-harvest new crop bids. I think the important thing is that, again, we're not anywhere near covering our total costs, But forward cash contracts right now are, for a lot of folks, probably offering a forward cash contract bid that would be over your variable cost or your direct expenses, adding in cash rent. New crop basis, again, a little bit weaker, but really only a dime weaker than what we would averagely expect. So again, I would argue that the new crop bids on wheat are probably what you might expect. Typically, they're not going to give you the average on that kind of stuff, especially this far out. But relative to corn, new crop wheat bids, I would say, are way more aggressive. With that, I'm going to turn this thing over to Dan. I appreciate everyone's time.
Say, Mark, before you take that down,
Yeah.
oh, that's okay. The I noticed on the corn especially that the new crop bid basis levels for the forward contracts, they were pretty wide, and relative to what you actually saw happen out there at by the time we got to the fall. And that, and if the elevators are being cautious about their basis bids, almost, as at least as I understand it, kind of a hedge against a hedge in their, not a formal hedge, but their own kind of protection against a whole lot of volatility and margin calls, et cetera. If people enter into those forward contracts, that you could, I guess it doesn't surprise me that the that the basis forward bids right now for this fall are wider than what we've actually seen happen year by year. And out here in the West, we've got one or two of those years where that one year, especially when we had such tremendous basis bids when we were short a crop, that may enter into that average too. What are your thoughts on that?
Oh no, I would definitely agree. I would definitely agree. But I always feel like, okay, let's throw that 5-year average out there because it gives us a point of
Oh yes.
of reference. And yeah, from my standpoint, yeah, I mean the bids are going to be the bids. And I think again, you touched on a good point last year. A lot of the corn was bought. And maybe we're not pulling out, we're not demanding anything. So there's a little bit less demand, a little bit less nervousness, and I think maybe a little bit of that expectation that we're going to see more corn acres. Maybe I don't know. But again, the thing I wanted to point out was that really the wheat bids only a dime away.
Yeah,
Bids,
the
40
wheat's kind
cents
of
weaker.
surprisingly
It's
close
just
to the average. Yeah.
yeah, it's just an interesting reference. But historically, if you go year to year to year to year, very often we will see that on the wheat side, right? That the dime, they're not gonna push hard, but they'll be closer to what we would on average expect. So yeah, good point, Dan.
I see a comment from John Smith. Talk to Elevator. They're charging so much for canceling 30 cents a bushel. Plus, you have to buy out or find grain if not produced. So I've heard of the buyout part, but the 30 cents, that's almost an in and out charge, out of an elevator, I guess. So should I go ahead and load then?
Yes, I'm
Okay.
done.
Okay. Well, thank you, folks. Yeah, Mark, I appreciate your work and putting yourself out there and actually identifying grain marketing strategies and price goals. It's interesting that on the corn number again, we did meet the first goal, but now we're kind of somewhere in the middle, kind of straddling the whether we meet the second or not. And we're still in February. We really haven't seen any crop production risk here in the U.S. really present itself yet. So still a lot of seasonal opportunity, I think, for price risks. So let's go forward. There we go. We do have some questions about the we might see it as kind of premature to do a lot of watching of weather, but we're starting out this year, and as we sit right today in the forecast for the next 10 days, Illinois, Indiana looks pretty dry. Ohio not looking just tremendous. Iowa dry all over. Eastern Kansas, especially the southeast corner, showing some dryness. Dry through most of Nebraska, and again, it's premature. We can get spring rains, things can change. But what I notice on this is that the ethanol plant corn bids in Ohio, Illinois, Indiana are higher than the Kansas bids. And I don't know that they necessarily have any more ethanol demand than us. So I don't know the exact reason for that, but but it wouldn't surprise me that they look around them, they see at this point pretty dry conditions, and probably bidding pretty briskly for ethanol, for corn going into ethanol plants. And internationally, we, of course, here in the U.S. for us, we're just approaching spring. You can see how our dryness looks, and then you see down South America, we have had reports, and the USDA is verified, I guess, by their February 11th projections, but that there's been some loss in corn production potential in Argentina in particular, some also in Brazil. Brazil as much by some late planting of, pardon me, late harvest of soybeans and then second crop corn following that's been pushed back. So some of what's been happening in the corn market has no doubt something to do with those factors. And we see this little bit of dry area. To us, it looks like a little bit of dry area. For us, for people producing wheat in Russia, it's a big deal in that they've had some deterioration in their crop prospects. Other issues going on around Europe. Uh, there's something to watch in the wheat market in that, as my understanding is that for the first half or so of the marketing year, that Russia just lets their grain selling companies just sell as much as possible. And when you look at the numbers, they've sold record amounts. However, that's likely in this last half of the year that at least market reports are saying that they have concerns about domestic supply adequacy, and that be the case, that it wouldn't be coming up long in here pretty quickly. They'll be announcing quotas for how much wheat can be sold. We haven't seen those quotas take effect yet. If they do come in and these dry areas are affecting wheat production, that may provide some support for the wheat market overall. Our biggest thing in wheat is just really struggling to have many exports at all. And we do have some periodic weeks where we'll jump up, but overall, if we have a pace for all U.S. wheat production, where we need about 21 million bushels a week to meet the USDA's latest projection. And for the week ending February the 13th, we had like 7.5. So we've really been struggling along those lines. And some issues in South Africa. They had some dry areas. They'll be normally they're at least a moderate exporter. They'll be importing some sorghum, I understand. Doesn't look like a lot of issues in China, India, but you do hear of different things back and forth in terms of their participation in export markets. And Australia turning drier. Now, a lot of what you see for production in Australia is over here in this eastern part. As we're looking at it to the west, they have some wheat also, but again, you're seeing some dryness creep into some of those areas. And on the grain sorghum side, for both the issue of China being in kind of a trade stress right now, I guess we call it contention with the U.S. They have stepped away from being an active buyer of grain sorghum. And to the degree then that Australia, which is about the other major exporting country in terms of sorghum goes, to the degree they have decent crops, that gives them an easy out for not having to come into the U.S. and buy sorghum. And the sorghum deal is pretty challenging in that I think 3 out of the last 5 or so weeks we have had zero export movement, not just purchases, but zero shipments of sorghum. And some of these trade issues are no doubt in play again. China buying 90% plus of any U.S. grain sorghum exports, and it's really had an impact on the sorghum market. Feed grains, So just hit on the major headlines. Now here I'm talking about this today, and we were joking before we came on. It's a lot more fun to talk about the grain markets on an up market day than when things are down. Here as we sit right now, I see on the side screen over here, March trading at 483, down about 8 cents. Again, the markets aren't closed yet, but decent, just under 470. But you stand back and look at where we're at in the corn market. Really, U.S. ending stocks over the last several months have been trending downward. It came out of January, of course. There'd been a cutback in U.S. Corn yields. I think it was down about 3.8 bushels. And so now we're instead of 15.2 or so billion bushel crop, now the final number is like 14.86 billion. So that had an impact on the supply demand balance sheet. Now we're at 1.54 billion. I'll show you a chart here later on that really shows we're kind of in an area of moderate support for prices in that. When we had corn prices $6-7, we were down to 1.2, 1.3 billion. So we're not that far with any crop risk from having a different tenure to the corn market, even than with more support that we've had right now. Stocks to use 10%. And again, we'll look at how that compares historically. So the corn market, I think it's fair to say that corn market is tight and it's at risk to what would happen in 2025 for weather. And if we only have 1.4 billion bushels and not 2 billion, then any crop threat that comes here in the spring is something that the market will respond more to, because it's, again, you're more at risk on the backside of this marketing year once you get out into August, September than you are right now. So moderating crop risks in Argentina, Brazil. We talked about that. They've had some moisture of late, but the damage was done earlier in Argentina. And again, I guess we'll wait to see how a little bit of a delay in Brazil in that second crop affects things. Has the potential to help U.S. exports, and U.S. exports for corn have been very good of late. Poor sorghum exports, as we talked about. Reduction from China. China still owns almost all of the pre-bought sorghum that's on the books, but my understanding is they're either rolling those or not taking them at this time. It's kind of like a rolling put option for them at this moment. And U.S. trade tariffs policy, as had been stated, as Mark had brought up, we're about 3 weeks in, or about 4 weeks ago, I think, well, February the 1st, there were announcements coming into that trade tariffs were going to drop. Well, we got 1 month reprieves for both Mexico and Canada. It was interesting, the points brought out. It wasn't, although I think the Trump administration has concerns about balance of trade, et cetera. The main issues that came into play here had more to do with immigration and importation of damaging drugs, i.e. fentanyl. That's what was talked about more so than other physical trade balance issues. So coming to that again, we'll see where that goes. And China and the U.S., again, ongoing discussions, and as such, right now the U.S. and the European Union aren't necessarily getting along well. You've heard the same political statements that I've heard, and they're also trying to wrangle their way through both those parties, along with the Black Sea region, to figure out how to come to a solution in the Russia-Ukraine military conflict. So a lot up in the air. The question that hasn't been asked yet is, if there's a resolution to this, what does that, and the war is done, and some of the sanctions that were on Russia are taken off. Does that affect wheat very much? My first thought is does that affect their trade much? My first thought is not really, because they've figured out ways to get around almost all the sanctions they had before in the wheat market. So I don't know that it would do a lot other than clear the deck a little bit in terms of what they have to figure out ways to get around. Weak corn sorghum basis parts of Kansas since fall of 2024. It's interesting to talk to farmers over the basically in January, February, and a number of them at conferences out to the west. Other parts of the state have talked about, hey, I've seen the run up in corn futures. I've tried to sell corn and sorghum out in the cash market, and there weren't any buyers, or really quite weak. When you go back to that grain stocks report here in Kansas, we have out of the total amount of stocks that stated that we had on December the 1st, we had basically right for corn in Kansas, we had 170 million bushels on hand out of 464 million. So, that's half would be 200,000, 230. So we're at 35-40%. So, and that's all across the state. Out here in the West, I wouldn't be surprised that we're even tighter than that. In terms of what's available. And for sorghum, again, looking at DS1 stocks, we basically have stating we have about 13% of sorghum stocks, sorghum grain still in hand in Kansas, and the rest of it all sold. So I know we're talking about weak basis levels, but if we only have 13% left to be sold yet, based on DS1 stocks, it mitigates that just a little bit. And higher U.S. corn plantings likely. CoBank came out, talked about, as Marcus, you'd mentioned, about 2 million acres higher for corn, and about sideways to a little bit lower, about 1 million acres or so for sorghum. Pardon me, for soybeans. I think so. This week, you want to be watching the news. There's the USDA has their Ag Outlook Forum. I get a chance to go to it this year. And on Thursday, the chief economist, Seth Meyer, comes out and gives USDA projections on corn acres. Now, I think the trade looks at those and they say, oh, that's nice. And then they go on. They know that the main issue, the main determinant of corn plantings and soybean plantings, the U.S. will be farmers with their planters. So, but without question, the so-so movement in soybean prices, and pretty strong corn, relatively strong corn markets has probably swung the balance toward corn. And when you look at new crop corn bids versus new crops soybean bids in Kansas, in every place except in central part of the state, we're leaning, I think. Well, we'll show that in just a minute. We're leaning towards corn in Kansas, much less what else they're doing around the country. We have some ethanol regulatory policy issues to unwind. Probably won't talk about that here much. And I just think seasonality be big thing to watch. Again, we're here. We've just are finishing up February. We're into March. Most of our seasonality comes in terms of seasonal support for prices off into April and May. The last 5 years, the highest prices, cash prices we've had for corn in Kansas on average have come in May. We still have some decent prices in April, some still in June, but if anything, that the highs have swung a little bit towards May for bids. So, Mark, our price, I realize we're talking about the old crop cash versus the new crop opportunities, but if the corn markets, feed grain markets, tend to show their strongest moves in May, June, for the marketing plans that you've got there, no doubt it will be on high alert to watch whatever happens there. Okay, just want a couple other things going on in corn. Note. Almost done with the month of February, and so the average price for the month of February through Friday, the 21st, the average closing price for, again, D's 25 was 472, a little bit higher than last year. And you can see where that compares with over the last several years. Surely not as high as where we were in 2021, 2022, 2023, but again, historically not too far. Well, historically, surely higher than the 2014 through 20 timeframe. I just wanted to show you something. I think where our grain price is going to go. Well, this is the opinion of the market. These are Friday's closes, and again, we're down some now, but note the carry in the market. March to May, again, there's May standing out a little bit more into July. You can see out here on the side the carry per month. But then if as the market puts its money out there in terms of where they think things are going, they're seeing prices holding up through May, in particular in July, and then dropping off into September, December. What's a surprise there actually is that the last few years, the lowest price we've seen on these big crop years has actually come in September, and we've come out of that in December. So that to me is a little bit reverse from what we've been seeing in the market. You can see this run up in corn, and pardon me, strong run, really from about October harvest time frame until now. We ran up to about 517, 518. Have come down some a little bit from there. 505 on Friday. It looks like we'll be down to 498 or so by the time we get to the end of today, if things don't change. But strong run for corn, and without doubt, it's had been factors that have been affecting that. Some of that down south, and I think if there's anything that's been a concern, it's that the higher corn prices have been eating away at ethanol profitability. But we'll see. Right now, we're hoping for good weather and everybody get excited and start driving in the spring to pump up ethanol demand and help support corn prices. Mark, I'd invite your comment on this. So we closed Friday. And this is the March contract. This isn't the D's out there. This is March 505. And we wonder, you and I, we agonize a bit to figure out what type of price, what type of price goals do you set as you try to put increments out there to bid up on. So here, so we closed on Friday, 505. Again, that's the March contract. But when you see 505, the only times we got above 505 since ethanol came into play back in 2006 was when we had wars, droughts. You can see back here at financial issues, short prices, all sorts of things happening in 2008. Pretty tight situation coming into 2011, 2012. We had the drought, came back to that again, dry conditions, South America, war, coming off that war, etc. We, in the corn market, on the corn futures, on the lead futures, we don't spend that much time above where we're at right now. Mark, what do you think on that?
I would agree, and I think and it depends on where everybody's at, obviously. And again, like I say, this is the March, but if we're thinking new crop, and I guess at this point, that's kind of what my focus is. Yes, if I'm covering costs, I think I need to ask myself, why do I not have a bit of a position? A little bit, a small proportion sold, because at this point, good weather, it could head the other way. Trade problems, it could head the other way. Again, knowing that it could go up. But again, if I can cover my costs, or at least my direct costs plus the cash rent, so I'm making my cash flow work. I think people should be looking at this. I think the market may be offering us an opportunity. Now, if you've already got 30-40% priced, then it's like, hey, let's back off and weigh this thing. But to me, I look at those kind of charts and what you got there, and it's like, maybe the market is offering us a bit of an opportunity. I think on your carries, right, we had that 6% going out to, or 6 cents going out to May. that's essentially covering if it's, on farm maybe. But if I've got it in the, if that's storage and I've got it in the elevator, that's probably what I'm paying storage. That's not covering my interest. So, it's not really a great opportunity to continue.
Well, I'm, uh, we don't want to, tell folks something that harms their financial management. But my point would be we have certainly had higher prices than this, but we had to have something out of the ordinary happen to bring them. So anyway, that's just a thought. It's a thought, something to think on now. Not again, we have plenty of things that probably bring us riskiness, cause and cause prices to hold up through probably through March, April, May, and maybe into June. But we're kind of it's not like we're at $3.50 wondering if there's ever any hope. It looks like we've had a run up and we're pushing ourselves into a mode where we need to be cautious and thoughtful about decisions. So thank you, Mark, on that. Let's move
Yeah,
on.
and I guess, and I please don't take any of these targets, et cetera, that I've got out there. They are merely benchmarks for people to kind of say, okay, Mark's saying 483. Well, maybe I would say a different number. But what I'm wanting people to do is to be thinking about these kind of things, right? I think that's the key is that they need to be thinking about if I'm not doing something, well, why not? And do I have a good plan? And definitely, yeah, my plan isn't always the best plan for far and away. That's for sure.
I'm going to speed through some things real quickly and then get on to wheat and then cover beans too. Just wanted to show you that where again, you've seen this from previous presentations where we show the position of traders in corn. And here last fall, we had almost a record low, record sell position for traders is going back to 2012. But here in the most recent run, we've had a record long position. So this is as long as we've been, at least since 2012, the drought years, and 2.225 billion bushels bought long. You can see the deterioration in the short position. So it's again, so the only thing that makes me wonder is, okay, I see that record position, but we're only at 502. How come if we have a record position, we're not at 803 or something where we were before? But I guess relatively speaking, in this time frame, we have we're in the mode where traders, speculative traders have been in relatively long positions, and we just it's an interesting time that they have those long positions. Will they maintain them or not? They'll have to have fuel for the fire to keep it going. And futures right now, again, the USDA is projecting 435 for season average price. And you look at this. This is our current seasonality chart, and it runs from where we're at normally. Here, February, we come into March, about sideways. April and May, then have a lot of variability. This is a 20-year variation. You can see the lot of from high to low, and then an 85th percentile either way. Holds up May, June, and then if when we in most of years when we don't see short crop come through, then we start to tail off. So we're in February, coming to March, April, May, June, when so much is determined. And just real quickly, just note here, you can see the cash markets. Again, Garden City, strongest cash market, 480 bid, highest forward contract bid in the state. Pittsburgh, Southeast, 462 trails it. 481 cash, that's for forward bids. Note down here on the bottom, you can see here that 2.3 is neutral. In terms of the ratio of the new crop soybean bids to new crop corn bids. So we got two areas of the state, Salina, North Central, Topeka, Northeast, that are about neutral between corn and beans. Everything else leaning towards corn more strongly, especially in the Garden City area. And that makes sense. That's where our demand center is at. Also out in Colby area and other places also about that. And that the ratio of hard red winter wheat prices to corn, 107, that's 105, 106 is about neutral. Wasn't that many weeks ago when we were seeing that ratio had fallen to about 98% when wheat was below corn, and we heard reports of cattle feeders coming in and at least showing interest in looking at that. Well, again, that situation has kind of rectified itself through a combination of futures and probably some local buying. We shall see. Note the weakness of basis, almost all across the state. That those blue circles being the basis areas. You can see the different locations we're looking at, and this scale on the left-hand side of those charts. And so, corn basis, especially weak in a number of these areas, either below where we've been in the past or equal to the low that we've seen. Pretty weak. And just note, so this is our corn market supply demand balance situation. Note that when we're at 1.5 billion bushels and 10.2% stocks to use. When we've had really strong corn prices, we were down in here, 1.2, 1.3 billion, 1.3 and a half, 1.4, and below 10% stocks to use. So we're just kind of on the brink of looking at this and then taking those percent stocks to use and looking at the type of prices they brought about, and then we see where we're at right now. Now, I know some people on here pretty astute analysts. They'll say, "Well, gosh, O'Brien, how come your 11.8% stocks to use is has a 455, and here you have a lower stocks to use and it's 435?" Well, that's a good question. I think we'll just move on. No, the point is that's kind of a issue of I think a lot of it has to do with the sentiment of the market, their overall perspective, and just had a lot of not many factors driving corn prices higher during those first few months of the market year, September, October, November, December. And now we're starting to see a little bit higher prices, and so much of those marketing year prices are determined by those first 5 months when most of the sales are done. And for sorghum, again, you can see the sorghum bids strongest again, Southeast Kansas, Pittsburgh, Topeka, 436. Everything else doing decently, but somewhat less. New crop bids best in a couple areas of the state. Again, Salina, Topeka, Garden City, Hutchinson, 435, 440, and some other areas slower. And sorghum bids, whereas the corn story was kind of mixed as to whether we were looking at the worst basis or not. For sorghum with the poor exports, gosh, just looks local basis bids really, really suffering for sorghum. And I just wanted to show you then, we got all this happening, but yet I would encourage you not to lose hope, because here you see the corn supply demand balance sheets, corn less China. You can see when China decided to start ramping up their stocks, et cetera, but corn minus China on even keel for comparison were the tightest we've been since 2007. So, we hear of optimistic reports down South America. Frankly, we need them because you can see how tight things are. Without China in the picture, 87 million metric tons, and that's lower than we've been any time since 2015, 16, 17. We've been tighter, but in terms of stocks to use, it's where we're at. So here I've talked a lot on corn. Let's and to respect everybody's time, let's hit the wheat major issues and the soybean issues, and then go from there. So for Kansas right now, you look at we have that 590 price for the planning price for revenue protection, and of course I think we'll come up in June. We'll figure the other side of that. Key issues: growing U.S. stocks in the U.S. overall, 794 million bushels. Well, we have an oversupply situation, almost 40% stocks to use hard red ending stocks to use is 57%. It was 48% last year. So we're for what we grow here, we've just got a lot of supplies. Drought risks, Ukraine, Russia likely to impact future Black Sea wheat crops and exports. So I guess I know things are rough right now, but if tougher conditions come in terms of Russia having to back out of the wheat market, then that has the potential to change things and affect U.S. exports. Lagging wheat exports to all major buyers, especially for hard red. Of course, we're competing against those crops coming out of Ukraine at cheap prices. U.S. tariffs policy, again, stay tuned. We're struggling so much in terms of just being price competitive in wheat. I'm not sure tariffs will make a lot of difference right now, frankly. Weak wheat basis through fall of 04, primarily caused by these poor exports. Again, we just don't have the demand pull coming at the local level. Higher value of the dollar, aggressive competitive sales by Russia, Ukraine, all in play. And again, our best thing right now, other than this thing that could happen in Russia with their domestic shortfall of in the latter part of their marketing year, is just what happens to the crop. And we don't wish. Generally, we always want to grow more bushels. We make more money that way, but there could be a possibility of any threat to the crop coming out here in April, May that would raise prices. So, and for wheat, it's an odd futures deal. so we've got March. Again, we're just about ready to enter into delivery for March 609. You've got positive carries and significant ones all the way out to May of 26, all the way out there. And you can see those 5-6 cents per bushel carries per month. Wheat stocks, it looks like here in that we can talk all this for old crop if we're still carrying that, but there's by DS1 stocks, we maybe have about 5% of last year's crop still around. So everything else is in commercial hands. You see that 633 and a quarter, and then carry thereafter. So it makes you wonder about where all that's going on, where it's going. I don't know that I'd be so bold as to encourage someone to consider long-term storage hedges, et cetera. But I think that's probably what the commercials are doing. They have these hedges here. They can carry them. They'll look for a good basis transportation opportunity, and so that's that. They're making. I'm not in any way critical of grain elevators at all. I mean, don't want to go there at all. But that's when they look at a carry like that. There's some hedgeable storage. There's some storage hedge opportunities there. On the farm side, we're probably not geared to think that way because of cash flow realities and all of that. And you can see had a little bit of run up in wheat, 626. It's probably 621 and 3/4 on Friday's close. So wheat's also showing some strength along with corn, and the 621 we've seen for wheat. It's not quite as pronounced as we'd seen for corn in terms of where 621 is at. Relative to some of the better prices that have gone on, but this whole thing that happened here, that's Ukraine, Russia. This was the short squeeze that happened in the market back in 2007, 2008 in terms of a delivery deal where we ran way up, came back down. We've had some pretty good years in through 10, 11, 12. As I recall, these years had a lot to do with Russia having a crop failure. 2 out of those 3 came in. But other than that, for wheat, you can see the 621 is more of a middle situation, not So I guess I'm struggling around to give us a strong answer on whether these are good prices to hedge at. It seems like more of a middling situation. We've certainly seen worse than this. When we've had better situations, that's politics and international issues have been so much of what's driven it. So anyway, Mark, do you have any comments on this when you see this wheat chart?
basically very similar to one of the corn in a way, right? We're trading kind of at these averages. And I think everybody, I think again, I just keep going back to, can I cover my costs, and should I consider pricing some if I can? Because I feel like there's just so much uncertainty, and in 3 or 4 months we'll know more. But for 10%, 20%, should a person, again, if I'm making my cash flow, right? If this is all about keeping me in business next year, am I, should I consider? And again, I think that's the thing, and people should, ask. We need to be asking those questions right now because we're at that middle. We're at that middle, and I think it's a time for some decisions and kind of running some numbers on how does all this relate to my costs.
I I guess the Black Sea regions become such a harbinger in the wheat market, in that these back in here had to do with the Black Sea region, and crop shortfalls, other issues coming into play, and this had to do with the Black Sea region in here, the Ukraine-Russia war. So, I we are not a market leader here. We are a market follower, and the leader in the wheat market is the Black Sea region. Let's go on. So again, you can see just so in terms of where the specs are. In fact, there's more pessimism. Surprisingly, more pessimism in what's speculative traders are doing. 450 million bushels short. The high here recently was 255 long. So even with what's happened with a little bit of run up here of late, still tending to be pessimistic on the wheat market. In projection, USDA projecting 555. The futures are thinking a little more pessimistic than that, although they have run up of late. And price bids. So here you go, Mark. So we've got some bids on Friday with the market was where it's standing. Hutchinson area just under 6. About that 594 in Salina, 589 Topeka, a little weaker elsewhere. These aren't, I would say these aren't necessarily tremendously attractive prices, but given the risks in that market, it's what we have to look at. And we've already talked about that Garden City wheat feeding incentive. And you can see the basis bids across the state, a mixed bag. Some of them really weak. Salina area in particular, Topeka, and I guess the weakest ones are in Salina and Topeka, and the others aren't doing great, but they're at least about equal to the weaker bids we had before. And just quickly, so we were at 40% stocks to use in 2020, went down to 30. 2023 are back to about 40. So in this year, and note how that's affected prices. So we were about 505 back when we were 40% before, with a little bit of inflation. We're about 40% now. We're at 555, and again, ups and downs in the market, waiting for something different to happen. And all of that, and you still see 10-year lows, stocks to use as 30-some%, and you can see everything we talked about for corn is exacerbated, even as much or more on wheat. So we still got this deal where it's hand to mouth, as long as countries like Russia, et cetera, they grow wheat, they need the cash, they sell it immediately, they don't store it, then that keeps the market down. And the thing they'll probably change that market someday is when they can't keep pushing it out the door at cheap prices, and folks have to look around, start looking for stockpiles. And oh yes, by the way, we've got them. So, and then soybeans here, we're running just a little bit long. I'll hit this quick. 1058 for soybean harvest, planning price for crop insurance, and you can see that has declined some from it's lower than the last 4 years. We still have a couple days left in that. And moderate ending stocks, but not necessarily tight. Still at risk to what happens weather-wise. Anything's probably one of the biggest risks to soybeans in the coming year is that corn attracts a bunch of acres, and soybean gets caught short on the acres we're planting it on. uncertain Argentina crop, drought unlikely. You still hear on the edge. We're still nibbling away lower on what's coming out of Brazil, about 1 million metric tons at a time. They've had to scale back their numbers. They're still a record high, but it's not quite as optimistic. We've had strong U.S. soybean exports to date, but South America is coming. When they harvest that crop, then China goes there. It's been their geopolitical preference. U.S. trade tariffs policy may impact soybeans. In fact, this is the biggest concern for where tariffs and trade could affect us, particularly because China pulls away, changes its attention from working with the U.S. They go exclusively to Brazil, Argentina, maybe. That's probably our biggest worry in the grain markets right now. Pardon me. We've had strong soybean oil and pretty good soybean meal exports. So eventually that helps crush on the balance sheet, mostly weak soybean basis. Soybean plantings likely level to lower. Biodiesel regulatory policy trade issues likely to be impacted by the Trump administration. I would not say the bloom has come off of renewable diesel, but with the weakness of the, well, if the West Coast is driving renewable diesel and they're having economic problems, political issues, et cetera, it casts doubt on the growth of renewable diesel. It's still a strong product, still have plants being built, but when the EPA in the last year didn't come out and bless continued protection for that industry, it made a big difference. Watching for market seasonality, March, September, both the U.S. and South America. So let's go to one thing real quick. So Mark, for marketing plans. So here's that same chart. 1057. We're in more of a middle of the road deal at 1057. We've seen some, we've gotten to 12 and a half, 13, et cetera. But I think the range of where we're at now, 1057 is just about in the middle where we tended to hang out. So comments on that, Mark?
Well, as I look around, new crop forecast contract bids were maybe within a dime of the 5-year average. So again, they're pretty good bids. Number one, and two, going back and looking at the farm management guides, these forecast contracts are offering, I think, for many people, it's covering your cost of production. And again, I think that's a very positive thing. Again, would love to see it higher. I have no idea where it's going to go from here, but the fact that I can cover some costs, I feel like these bids aren't too bad. Yeah.
I think that so this USDA report, USDA conference this week, that'll give the first set of numbers to look at. Then we'll have at the end of March, prospective plantings report. We'll go on. We'll see how plantings go forth. And there'll be acreage report actually coming out at the end of June. And the first USDA projection, WASDE, will come out in May. That generally is large crops, the market kind of discounts that a bit. But you can see this information that'll keep coming in throughout the year and throughout the marketing year. We'll get into April, May, June, and we'll just have to work our way through what the prospects are at that time. So with that, let's go for some. Okay, there we go. So thank you for folks that have stayed with us. We too much going on, get too excited about talking about. Let's check the questions real quick. Co-op bids, et cetera, including basis. I'll be honest, Jane, that I have a subscription to a local service. I happen to go to DTN Grains. That's where I pull mine out of. And frankly, a lot of these you can go on a daily basis to kind of your group of elevators you're considering, and they'll have their own grain prices. Now if the basis is what you're after, yes, we have the basis. We have basis charts on Ag Manager at www.agmanager.info, and you can go through that and type in and you can check and see if we've got your local community elevator basis bids there, and we cover most of them, I would think.
Folks,
let's-
I've set it up so you can unmute and talk to Dan or Mark if you want to. You can go ahead and type stuff in the chat as well. But if you would like to just unmute and be able to talk directly with them, that'd be fine.
Yeah, I saw a question on there regarding my plans and the fact that some are only adding up to 40 or 50%. Great question. And again, I think from my standpoint, it's that whole cautionary thing of I don't know whether some of these policies and tariff threats to not tariff threats to trade wars. I mean, some of these things in the weather all could turn to be very positive. And so, basically what I'm creating or suggesting people take a look at is okay, let's delineate out 40 to 50%. Because on my corn, it's actually 40, right? I did 20 already because at that one price we got a target for 10, and then it's a 3A or 3B. So that plan basically outlines marketing roughly 40%. And the thought process behind that is let's get through March, April, get more information. Let's see where the tariffs, is it negotiations and it didn't really hurt our markets? Are we in a trade war? But, what it's doing is I'm trying to drive, or my thought process is let's get some sales on the books at prices that, if they are covering my costs, and then for the rest of my production, let's finish out that marketing plan once we have a better idea, and we listen to Dan and we get a better handle on where this market may be going, and with the point being that maybe as we get through March, April, into May, we'll have a better idea on South American crop planning progress in the U.S. and maybe more where we stand on some of the trade issues.
And so, Mark, what you're aiming for your total amount, are you aiming at 50 or 60% of your total expected production to be sold, and you've only acted on 20 or 40% so far? Is that the way to think about it?
Well, yeah. When I put those plans together, basically, I'm suggesting this as a percentage of your APH production, and so each of these plans are outlining roughly the potential to make sales of anywhere from 30 to as high as 50% of your APH. Again, that's not knowing. And if you look at some of those targets, I don't know if we're going to hit some of those targets. So we may be stuck with on the corn, we may be stuck at 20% price. But if we see that thing bounce up, it kind of scares me when we see that many specs, Dan, that are on the long side of the corn market. Don't know what it might do, but we're seeing the opposite a little bit on the beans and the wheat. So, like I say, I feel like there's a lot of uncertainty. So my goal is to very quickly let's get 25% of my APH. Let's take a position, especially if I'm covering my costs. Right? There's a lot of uncertainty, and if we look at a lot of people's balance sheets and things, I think we need to make sure that as we go into 2025, if I can cover my costs, I'll be around farming in 2026.
And on those budgets, when you talked about that, if you cover all the direct costs, all the seed, fertilizer, et cetera, the fuel, and you cover the cash rent, then what's left would be farm machinery and your draw from that enterprise for family living above that.
Yeah.
That's what you'd have left.
Yeah, I think having an idea of what our costs are has never been more important.
Yep.
Because again, like so many charts that mine were showing, but also yours on that long-term stuff, we are really at that area that it's going to take something significant to move us higher. And if status quo stays, it could just continue to be sideways.
That's most pronounced on corn. For wheat, you'd probably get there with, if it's $6.50 or $7. For soybeans, you get to $11 more so, but corn, you're there. It's less clear on wheat and soybeans, to be honest. We didn't talk a lot.
Just to go on the other part of that question, I saw on the comments from Ward. Basically, again, no, that's of total production, and that's whether I'm using, because again, we all need to assess what tools do I want to use. Like I say, Dan and I will go out and do workshops. And you like I say, you ask, and there's a lot of people that no, I don't want any part of futures. So it could be applying to what we're looking at as far as forward contracts too.
Just pull up here real quick. Looking at options, that these corn. If you say I don't want to I want to sleep at night. I don't want to mess with this stuff. so you should buy a D's corn put option 469 and a quarter. Last number 470 put is 36.5 cents. So they make that 40 cents by the time you pay brokers or whatever. So 470, you're down to 430. So it looks like with a put option premium in there, you could set a floor at about 430 futures, and then you'd have to adjust for your basis. If you're out to the west and you end up with a positive basis at harvest, then that's 440, 450, something like that. So that's interesting to look at. And really, probably the bigger issue I'd say would be in looking at hard red winter wheat, July. For us, July, we have to be out of it at the latter part of June, but still July options at the money, say a 620 July put is also 35 cents. So 36, make it 40 again. So 580 futures for July. You'd have to get out of that again about the last week of June and then take your basis off of that. That's down to $5 or something. So that doesn't look as attractive. It doesn't look as attractive right now, but given the risks in the market, it's always something to consider.
Well, I'm not seeing anything else, so I think we'll go ahead and call it for today. Dan, Mark, thank you. Appreciate you doing this. And we'll be having more of these. I don't know if we've got dates set on that. I don't have them in front of me, but we will be letting you know about it. So
it's that we aim to have it that month, if we can pull it off, that last Monday or Tuesday of the month. Now, and what we'll consider here in March is how do we work around the prospective plantings report. So we'll take a look at that, see what we can do to try to handle that correctly. So anyway.
All right, cool. Well, thanks for being on, and look forward to having you in the coming months here.
Thank you, folks, for coming. We appreciate it.